I'm going to do something that most syndicators would never do. I'm not going to talk about all the great stuff about our upcoming acquisition, Solana at the Crossing. Even though I love it, there's a ton of things to just brag and just rant and rave about. I'm only going to talk about the downside and the risks, just so everyone can go into this investment, and you should do this on any investment with eyes wide open to see what those potential challenges and pitfalls could be. Not that there aren't some black swans that could pop up, but we want to make sure that when we go in, we can really quantify these potential risks, and so we can mitigate them as we go into it. Again, with eyes wide open, as opposed to heads in the sand saying, oh, it's a great deal and it's in a great everything. It's a great market. We love it. Again, that may be true, but we have to take a mindset and an attitude of let's make sure we find the problems, because it's got to be right for us, for our investors. And it still may be right, but if there are problems, which there are always problems with any type of investment, what are they and what are we going to do to fix them? So I'm going to go over a few. The first off is the new supply that's coming into the market. As you know, the nation is delivering more apartments than we have delivered in 50 years. Now that is bringing our occupancy levels down and vacancy levels up, and it's also suppressing rent growth. Last year in 2023, rent growth across the nation was negative. While in Indianapolis, where Solana is, it was positive. And we've seen some positive trajectory in rents this year, but still very slow compared to the last several years. And even before the pandemic in 2019 and earlier, we're seeing some lackluster growth. Not surprising with all the new deliveries. That being said, we are anticipating more deliveries to come online throughout 2024 into 2025. Those deliveries should slow down in the second half of 2025, and especially when we get into 2026. But without a doubt, there's going to be a lot of supply pressure. Now, Indianapolis is delivering about 6% of new inventory compared to what already exists in the market. Other markets in the Sun Belt are delivering double-digit new supply relative to inventory. So, we're relatively moderate, but we're still seeing more supply than we've ever seen. Fortunately, demand and absorption is really cooking at almost over a 20-year high. That's how we've been able to maintain positive rent growth, although vacancy has increased somewhat. So the risk here is, we're trying to push rents in the first year of operations, primarily because current rents at Solana are $200 to $400 below current comps, which $600 representing kind of that brand new construction properties that are coming onto the market right now, that new supply. And that $200 to $400 really represents properties that are true comps to the Solana, that have a very similar vintage year in the same school district, kind of same submarket or adjacent to the submarket, where we think are really good comps. There's no reason why we can't mark to market Solana's rents to increase them that $250, so we really can just be at the same rent levels of nearby properties, not really pushing outside of much organic rent beyond that, but saying we're offering almost the exact same product type. In fact, a better product because it's larger and we're going to do some upgrades. And we've got a much better amenity set with our resort style pool, our 22-acre bay, boat slips, you're in nature, et cetera, et cetera. So we're confident that we can get the $250 because there is just that mark to market opportunity without relying on additional organic growth. That being said, there's gonna be some pressures with new supply coming in the market, and that's why with Gray Residential, our in-house property management team, being local owners, being local managers, we're best suited to be able to take on these challenges of navigating additional supply, out-marketing the competition, and just out-operating everyone as well. So the first risk is the new supply. Now that's a short-term, kind of a transient risk because again, supply is going to fall off in 2026, but it could affect potentially the returns in the first 2 years of operation. Now, if we get no rental increases at all, like we tell the current owner to stop increasing rents and we don't increase rents, we're still cash flow positive. We should still be able to deliver, a mid 5% return. I think we can still get to 6%, but that is the risk. It's not a risk of loss of capital or the deal going wrong. It's a risk of reduced cash flow, and it's going to be on us to execute the business plan and push rents in the right way, in a manageable way to achieve our target pro forma levels. So the second risk, however, is the makeup of the rent roll and some issues that the owner had this last year going into the winter season. The owners initially brought out Solana for at an $84 million purchase price. That's compared to our $68,250 per price that we have under contract. But what happened right around that time is that there was a large corporate lease, 30 corporate units, where that company went bankrupt, and they canceled all of their leases in a single day. The property was in the low 90% occupancy, and it brought them down to the low 80% occupancy. Needing to get the property in a position to sell it, the property management company overreacted, really lowered rents, and started leasing up. Fortunately, and credit to the property and credit to management, the property is currently occupied at 96% and they're pre-leased to 98%. So they've got it leased back up. But the biggest concern that I have, because I've seen this before, it's not our first rodeo, is what some groups can do or will do to get occupancy up in a short period of time. We want to make sure all of the individuals that sign leases actually are qualified to live at the property, they can afford the rents, and that they were going through the proper screening processes. So we need to go through and clean up the rent roll and make sure that everyone that's living there is qualified to live there, and then they can pay rent. Now, that's going to be a process, and that could add some volatility in the first year of ownership. It's not something that's really unique to this property, having to clean up a rent roll and to deal with unideal screening processes. But it's something that I've seen in the past, and I think there's a good opportunity where we might have some issues on the rent roll and deal with some collections. Now, it doesn't seem like it's a major issue at the property right now, but it's something me and my team need to be fully aware of, and you as a potential investor should be fully aware of, as something that we are really drilling in on. We're finalizing our full lease file audit kind of as we speak right now, comparing every single lease to the rent roll. Did they have a dog in their unit and there's no pet rent on their lease, but also how did they qualify for this apartment? Again, it's something that we have to do on every single acquisition. But when I see that occupancy dropped very quickly and then they had to quickly lease it back up, there's potential, I'm not saying that this absolutely took place, but there's potential for them to skip on some of their screening steps. So in my mind, and again, I don't think any other syndicator would tell you this level of detail, but just being fully transparent in the way that I'm seeing it right now, that's a risk that I need to drill down on and to quantify how big of an issue is it. Because it's something that we can manage, but we have to be prepared to manage it. And again, we can't put our heads in the sand and assume everything will just be okay. So cleaning up the rent roll and making sure that our delinquency is minimized is a potential risk in the first year of operations. But again, the way that we're going to mitigate it is getting ahead of it, to understanding the makeup of the rent roll, what are in the leases, and identifying those residents that may have an issue before we buy the property, getting our property management team, and we have a portfolio specialist that works with residents who are having delinquency and collections issues directly, getting them involved from day one to nip any of these issues in the bud is a top priority. The third risk I want to talk about is interest rate risk. Now, I don't like floating rate debt just as a general rule, but I see debt as a tool. In the right situation for the right job, you've got the right specialized tools. In the case of Solana, we're assuming a floating rate Fannie Mae loan. Now, I'm comfortable with that because there's 7 years of term remaining on the loan, 5 years of interest only, and a very minimal prepayment penalty that gives us a lot of flexibility. But also, compared to a fixed rate loan right now, the loan proceeds would be so much lower that the returns would be significantly lower. And my opinion is I don't think interest rates are going to be ever returning back to where they were kind of in the early 2020s. I think they'll probably come down a little bit from where they are today. But so the risk in the deal is, if not that interest rates don't come down, we don't need interest rates to recede, but if interest rates really increase materially, if the Fed funds rate in SOFR moves from 5.25%, if the Fed decides to hike interest rates further to 6-7%, that would not be good for the deal. Now, we could sustain, if the Fed funds increase was up to 6.5%, we could actually, based on our projections, still refinance in a couple of years and get a decent cash out. Much smaller than we would like, but the deal would still be fine. And again, we have 7 years of term, so we don't ever have to refinance. We could continue to purchase rate caps and continue to hold the deal for 7 years. Our plan, though, is to refinance before 4 years, put a fixed rate loan on it, and remove interest rate risk from the deal entirely. But I'd love to do that when rates were just a little bit lower or after we've increased rents a little bit so we could get a nice cash out. Now, again, there's more risk in that to just putting a fixed rate loan on it today. It's my belief that that's the most accretive way route for this deal. And I think the risk adjusted returns make sense and justify this decision. But again, in transparency, it is a risk. If interest rates absolutely blow out, it's not going to be good for the deal. And that's why we want to get onto a fixed rate loan as soon as possible. The reality though is, as long as interest rates kind of stay within a range, you can even increase a little bit. But as long as we maintain into a range, we'll be able to refinance within 4 years. I would love to be able to refinance within 12 to 18 months, whether we've increased rents or interest rates have come down. And if we get the double whammy, which we're not projecting, if we get both of those things, then we are looking at a potential really huge and attractive cash out refinance that will return capital to investors. Everybody stays in the deal, and we can basically de-risk the asset and then enjoy cash flow after that fact. But again, we'll be taking chips off the table. It's something that always we look to do in any of our projects as it makes sense. So without a doubt, we're really watching this and carefully want to mitigate as interest rates move, but interest rates are still a risk on this deal as well as the rest of the market. Because outside of this deal in particular, if interest rates do continue to rise, that will most likely lead to further price declines in the multifamily market. Again, it's our base case that we are near the bottom, maybe not at the bottom, but we're relatively close. And the fact that we're buying Solana for a 25.5% discount compared to the rest of the previous appropriate sales comps over the last couple of years, we're within the range of value where I think we should be. And then our ability to increase rents over time, mark to market the rents to the comparable properties. And we're very confident in our business plan, but certainly nothing is guaranteed, nothing is certain, and there's always risks in any business venture. You're probably watching this and saying, I don't know why Spencer would just talk about all the bad things that could happen in the deal. But the reality is every investment has risk. I'm incredibly proud of my team, the fact that we've never had to issue an unplanned capital call. We've never lost an investor dollar. And I believe that over the last several years, we've proved our ability to quantify risk, mitigate it, and take discrete steps to move away from it. And our investors have enjoyed investment experiences and opportunities that have been able to avoid some of the distress, or most of the distress that the rest of the market has seen. Just one property that we did buy in 2021 with a bridge loan, it was the last bridge loan we've ever utilized. We executed our value add strategy and we ended up cashing out on a refinance even as interest rates had risen and increased the value of that property by $5 million. This is in the exact same time period where other operators, other syndicators were issuing capital calls to save their deals. Now, we did inform our investors months in advance of saying, our interest rates have increased, our debt service is up. This is going to be a challenging period. This is what we're going to do. These are the risks. And I even said at one point to our investors, there's even a possibility we might have to issue a capital call or issue a member loan, and this is what that will look like. We never ended up having to do that because we were able to execute, but we wanted to communicate the reality on the ground early so there was not a surprise. It's not easy for me to be late to communicate to you because, again, if you're surprised, you're not going to be too happy, and then we have to go back and forth, and that's not fun. I'd rather be transparent, just get it directly, without a filter, without sugarcoating it, because, that's the reality. And we know our investor base are sophisticated investors. They're grown-ups. They understand that there's risk to every investment. We appreciate that, and I think our investors appreciate that we respect that as well, and we're really on the same page with our interest aligned. Most importantly, just because, as investors, we're co-investing so much into these projects. We're often the largest investor in any of our deals. So again, why am I doing this? It's to be transparent. It's to stand out a little bit and to say, no deal is perfect. We love Solana. It's a great investment opportunity, but every opportunity, even it may look beautiful and shiny, every opportunity has risks. And I think every investor should go into an investment having their eyes wide open and fully informed of all the risks in the deal. All right, thank you. If you're interested in investing in Solana, if you're a accredited investor, hop on over to graycapitalllc.com. You can create an account on our investment portal, schedule a meeting with our team, conduct your due diligence, and make your commitment all online. It's really easy to do. Do as much or as little due diligence as you want. I recommend you do at least a good amount and consult your advisors. I'm looking forward to partnering with you on Solana. If there's anything me and my team could do, never hesitate to reach out. All right.